Well, I would now like to invite our esteemed panelist on stage, please. Well, he's a recent winner of 40 Under 40 Investment Professionals Award in 2023. He is presently designated as Vice President and Head New Product Development, Index Research and Analytics at NSE Indices Limited. In his present role, he leads a team that is responsible for developing new innovative indices across equity, fixed income, and alternative investments. He has previously worked with CRISIL in index development and fund research space, and also had a stint at a global investment bank in New York City. He is the CFA FRM charter holder and also has keen interest in teaching investment and risk analytics. Let's welcome Mr. Aman Singhania. Very warm welcome, sir. First one. Well, our next panelist heads the passives business for Aditya Birla Sun Life AMC and is responsible for setting up the foundation and strategic roadmap for the company in this area. He brings with him over 20 years of rich experience in asset management and investment advisory services across sales, business development, new geography development, products, and strategy. Well, he completed his bachelor's degree in commerce with honors and holds a master's in business administration. Please put your hands together for Mr. Abhishek Singhal. Warm welcome, sir. Well, our next panelist is the head products and alternatives at Axis AMC. He joined Axis AMC in 2010 as a portfolio manager, PMS, and later elevated to the post of head products. Prior to his engagement with Axis AMC, he was associated with IDFC Asset Management Company as a portfolio manager, structured products for 3 years, from 2007 to 2010. Well, he is a postgraduate from IIM Calcutta and has done his BE in metallurgy. He is also a CFA from USA. Please welcome Mr. Ashwin Patni. A warm welcome, sir. Our next panelist is the Quant Fund Manager for PMS and AIF schemes at Motilal Oswal Mutual Fund. He has over 8 years of experience in capital markets, largely focused on the design, research, and management of quantitative investment strategies. In his previous engagement, he was managing a proprietary portfolio using multi-factor models at Alpha Alternatives, an alternative investment manager. He is an engineer from the National Institute of Technology, Nagpur, and an MBA from the Indian Institute of Management, Indore. Please welcome on stage Mr. Krishnan. Very warm welcome, sir. Well, our next panelist is the fund manager and head, passive, Arbitrage, and Quant strategies at UTI AMC. He is a CFA charter holder from CFA Institute USA and also holds a postgraduate degree in management, MMS, from Wellenkar Institute of Management, Mumbai. He has over 15 years of experience in risk management, equity research, and fund management at UTI. Let's welcome Mr. Sharwan Kumar Goyal. Very warm welcome, sir. And our last panelist joined Bandhan AMC Limited, erstwhile IDFC AMC, in May 2019 to fill the newly created role of head products. In his current role, he focuses on conceptualizing product-to-market strategies and ways to communicate the same to various stakeholders. Well, he brings with him over 25 years of experience working in different roles within the BFSI space. Before joining IDFC AMC, he was the head of investment products and strategies at Standard Chartered Bank. He's completed his MBA in finance from ICFAI Business School and at the same time became a CFA ICFAI. He completed his Bachelor of Commerce from the University of Kolkata. Ladies and gentlemen, please put your hands together for Mr. Sirshendu Basu. Very warm welcome. Prem, sir, over to you.
Thank you. Thank you so much, and wonderful to see all of you here. We are going to be talking about the trends in the passives business. So what we will try and do is to deal with some of the issues which are top of our minds as far as passives are concerned. But before that, let's get to the big picture first. I know all of you represent passives in your organization. Of course, Aman works with NSE, so he has a vested interest in promoting the cause of indexes. But how soon do you think will passives beat the actives category in size in India?
So given the, so passives currently is about 18% of all industry. And we've grown as an industry, and much credit goes to all the partners here, at about 23-24% on an average. But if you look at the last 5-6 years, passives is singularly driving the industry. If you look at last 1 year maybe, the entire growth for the industry has come from passives. My guess is if you were to take a leaf out of the US history, the last 1 decade, contribution of the passives AUM has more than 5 times gone up in the US market. Oh. And the same thing will pan out here in India as well. We are at about 7.5 lakh crores. I would bet in the next 5 years, we will be about 16 lakh crores. And we will be at the same place where US took 10 years to reach in the next 5 years itself.
Okay. Okay. Ashwin, how important is passives at your company, Axis Mutual Fund?
I think it's not a stage where, and just echoing what Abhishek said, that there is no. I don't think there is a choice anymore. I think every single company realizes that this is a mega trend. It's here to stay, and it will be a very, very consistent sort of move towards more and more share of wallet, whether you see it from an investor's perspective or a manufacturer's perspective. We're still finding, I do believe that we're still finding our feet. While the numbers have become large, I think as an industry, we still, I would say, are still on an early part of the journey of how to incorporate passives into our portfolios, how to structure passive strategies. It is ultimately one of the challenges in India we always have is it's a shallow market from a liquidity number of stocks perspective. So creating, a lot of differentiation, etc., is quite limited. So I would say yes, we are also trying to. It's a big priority area. I don't think anybody can choose this anymore, but it is also something that will require a lot of thought, how to create new ideas, how to create use cases for people to be able to take advantage of this.
Okay. Okay, I'll move from this part to another one, which exercises the mind of people who are dealing with passives. How are ETFs and index funds different from each other, and what is relevant for who, in what context?
Yeah, at the outset, very good morning to all of you. It's lovely to be with you today. And Prem, to your question of how ETF and index funds, in fact, from an overall passive standpoint, and as both Abhishek and Ashwin alluded to the fact that it's actually not a, I would say, satellite thing. It's a mainstream category, and which will evolve as we progress. And we've seen that happening in the last 2-3 years quite aggressively. Now, from within the passive basket or bucket, if you look at, we have ETFs and we have index fund as well. Both have a specific requirement. If we look at from a retail standpoint, ETFs, as we all know, can be traded like any single stock during in the exchange during market hours. So if an investor who wants to trade in, let's say, Nifty, can do that during a trading period in a day, or can choose to time the market for buying for investment as well, because it takes care of the intraday volatility quite aptly, as opposed to an index fund which would be the NAV would be calculated basis the end of the day score. So therefore, from that standpoint, it kind of gives a better price point for investors who is looking at, and that is one of the difference. But as they say that in equity, more importantly, it's the time in the market and not timing. In that case, in fact, it remains as convenient to be into index as in ETFs out there. So therefore, we feel that can be or is one of the difference which is there. The challenge which generally investors face in ETF is the issue of liquidity. But we've seen that there are being ways being brought in by the regulator to address that as well. But if I just stay to the point of ETF and index, I think they have a market of theirs independently, and we expect to see significant growth happening in both the aspects.
Okay. From your perspective, can you tell us in which situations should a distributor recommend ETFs and index funds?
Thank you. See, from portfolio manager perspective, both ETF and index funds ultimate aim is to replicate the benchmark. So from that perspective, both will generate closer to benchmark return. So it depends upon the investors. If investor is aware about the nuance of secondary market trading, in the sense, if he's having demat trading account and he understands how to transact in ETFs, and actually he wants to take advantage of intraday price movement, in that case, that particular investor may prefer ETFs. But index funds are convenient and hassle-free mode of investment, because investment in index fund is just like any other mutual fund schemes. And since most of the distributors are investing in, or investors are investing in mutual fund schemes, in that case, index funds could be much more convenient as compared to ETFs. We have heard that people focus too much on expense ratio or TER of ETF versus index fund. One needs to understand that in case of ETF, apart from expense ratio, various other parameters which are also important, because secondary market liquidity hasn't taken place in a big way in India. So apart from total expense ratio charged by AMCs, you should be focusing on overall cost of ownership, which includes demat and trading charges, brokerage cost, and impact cost of secondary market liquidity. So investors should evaluate ETF versus index funds from overall cost of ownership perspective, rather than just focusing on expense ratio.
Okay, good. Your views?
I agree. It's ETFs, I think, are suitable for, at least in the way they are right now, they are suitable for a lot of those big ticket investors who, treasuries, for example, who have, strong views about when they want to enter the market, and they have the capability and the nuance to capture intraday movements. And they also come in a big way. So for them, ETFs actually make a whole lot of sense, because that's a more efficient way in which they can actually create their exposures. For a more retail investor whose ticket size is not that much, like is already mentioned, the overall cost of ownership is not only the expense ratio, it's also the cost of impact, which at times could be very high because of the low liquidity, and the liquidity not being, not improving. Hopefully in 3 years' time or 2 years' time or a year's time, we may start seeing a lot more liquidity, and hence the cost of ownership comes down drastically, and the choice is actually not that significant. But as things stand today, for a retail audience, for someone who's not looking to buy 20% of the fund outright, index funds make more sense.
Aman, there are so many ETF categories, there are so many index categories. There are over 400 funds, and with so many categories in existence, how do distributors understand what these products are supposed to do and represent? So aren't you creating a situation where you're making the product category so complex that distributors, forget about lay investors, have a difficulty in understanding which product category is supposed to do what?
Good morning, Prem, and thank you for having me on the panel. I'll first touch upon the first question which was asked to the panel, and then maybe I'll come to that other question. In terms of passive beating active, so just taking a step back here, India passive AUM share is around 17-18%. Global average is also 16-17%. So we are on par with the global average. More developed countries, the average is around 24%. So US 24-25%. So 1/4 of the money is in passive. Now, active and passive don't really need to compete with each other for them to grow individually, is what we believe. We are a 41.5 trillion industry in terms of AUM. We are 17% of GDP presently. Global average is 75%. US is more than 100%. So there's no doubt that the overall pie is going to increase significantly from here. If the industry has to reach from 40 trillion to, let's say, 100 trillion INR in a couple of years from here, and even if we maintain our market share, the passive market share of 17-18%, the 6.7 trillion INR industry will automatically grow to 17 trillion, right? And if we continue to see this trend of skew towards passive because of various reasons, and if we were to converge to global averages of 24% as we develop, as the economy develops and all, we were to reach a 24 trillion passive on a base case scenario, if other things move together. So I think passive can grow on its own. It doesn't need to really, compete with each other. The pie itself is so huge. We are sitting on 180 trillion fixed deposit market. If that's, even a minuscule part of that starts moving to the passive, this will grow on its own. Now coming to your question of confusion. So we have, 330 passive funds today, debt and equity put together. I'm not counting gold in this. 220 equity passive funds, 108 debt passive funds, aggregating to 6.7 trillion of the overall AUM. Now, is there confusion because of this? Is it too much? We don't know, because we don't know how much is too much. US alone has 3,000 ETFs. And for perspective, US has 3,800 stocks listed. So the ETF to stock ratio is very close to 1, very close to 1. We have 2,000 stocks listed on NSE. We presently have 220 equity ETFs, right? So we don't know whether 220 is high or low. However, the question of getting confused is valid. And what will help maybe remove that confusion and dilemma is maybe awareness. So for example, as a layman or as a distributor, when I look at these 330 passive products or 220 equity products, for example, passive equity products, I will definitely get confused. But 36 out of these 220 passive funds are tracking Nifty 50 alone, for example, right? Now, do I count them as 36 or do I count them as 1? Because ultimately, all these 36 funds are giving me exposure to 50 blue chip companies of India. So they are, in a way, similar in strategy. So when investors start looking at these 36 as 1, right? Of course, out of these 36, few are ETFs, few are index funds. And there are always pros and cons between ETFs and index funds. You can choose what suits you. Within that, AMCs, of course, competing in terms of liquidity, tracking error, and cost. And whoever is best is more popular, and money will automatically drive into those categories. So likewise, if you look at these 220 funds, equity funds, they are tracking 56 unique indices. So the confusion gets maybe lowered by looking at the index and then looking at ancillary things like liquidity, tracking error, and the cost of ownership, and then make a decision So if I've made a decision to invest in Nifty 50 to start with, then I have 36 choices to make. But the decision to invest in Nifty 50 is 1 out of 56 and not 1 out of 330. So I hope awareness would help in maybe lowering the confusion, while knowing that passives are helpful from an overall portfolio construction point of view. The previous discussion was on the core and satellite approach, where the core can continue to be passive and you can experiment on other strategies around passive. Having said that, if I can add, there are ancillary strategies like ESG, Sharia, value, momentum, and like that, they add up to a lot of indices that we have. Is it again confusing? Every investor need not invest in all the passives. There has to be an alignment between the index or the product and the need and the goal. And if that alignment is there, so for example, every index is meant for a belief. So Sharia, for example, is meant for a very specific belief in investing, and it's meant for them. ESG, for example, is meant for a belief on sustainability. And if it appeals to you, then you invest in ESG, otherwise you don't invest in ESG. Likewise, value, momentum, quality, growth, low wall, these are strategies for which indices are made. There are products onto these indices. They are available to investors who have a belief in that factor, in that theme, in that sector, or in that strategy. So I hope that helps in lowering the confusion.
Just out of curiosity, ये concept लाता कौन है? आप लगाते हो कि ये 5 लोग लाते हैं आपके पास में?
Very interesting question. I think it comes from brainstorming between us and them. So we personally, I know our team interacts with all mutual funds all the year, and it comes from a lot of discussion that happens. Of course, so the good thing is there's already a precedent for us globally available, right? So that is a reference for us, right? Because they are way ahead of us in terms of, sophistication, in terms of size. So there's a reference, and then taking that reference, okay, we discuss and make it localized and nuanced to the Indian market. So I hope that answers in terms of how we come up with these strategies.
Now, one of the biggest, sorry.
So if I can just add on the point about confusion. I don't think there is any investment product, this is money we are talking about, which entails itself to a lazy approach that you just see something on the label and invest. You can talk about the simplest of passive ideas, is a Nifty 50 index or ETF. We already discussed that even to participate in Nifty 50, there is a choice between ETF and index you need to be aware of. There is a concept of what goes into Nifty 50 that you need to be aware of. And there are within, if you look at large cap itself, there is a Nifty 50, Nifty 100, there is a Sensex, etc. I don't think passive is a license to be lazy. I think it will require work, whether it is on part of the distribution partner, the advisor, the investor themselves. And that's point number one. Point number two, the challenge that I foresee with passives is how do you explain performance? With active managers, you can beat them up, but at the end of the day, there is a thought process which they can explain of what they're trying to do in a portfolio, and sort of how do you relate with, what they attempted, it worked, it didn't work, whatever happened, but there is a thought process which is actively managed. If the Nifty tanks and you're in a Nifty passive funds, who explains to you what has happened? And that is, again, goes back to my first point, which is there is no shortcut to this, unfortunately. You have to spend the time and effort to educate. There is, just being in passive does not give you a license to sort of skip the queue in that sense.
Okay. I want to come back to an issue which some of you mentioned in passing, which is the issue of liquidity in ETFs. So what is the nature of the problem and what is being done to fix that problem?
So as Ashwin mentioned, largely passives is seen as lazy investment. And hence most people just simply think about passives as just buy and sit tight. Passives is largely used for trading also. It is an advisor's tool more than an investor's tool, in fact. And just to maybe loop back to the earlier question, how do you use it? How do you select it? When you create an advisory, when you create a portfolio for an investor, you choose passives, ETFs or index as part of portfolio, as some of the components in the portfolio. And when many participants start doing the same thing, that's when trading starts. That's when liquidity is required. Somebody wanting to get in, somebody wanting to get out. While stocks are getting traded pretty actively, ETFs so far have not been traded very actively on the exchange, and largely it's been a buy and hold. It's only been institutions who have been pretty active in this space. But given the change in the regulations very recently, 1st of May, you will start seeing more and more of trading activity on the exchange as well. We need to have a fairly deep market making mechanism. And I'm guessing with this change of regulation, with the efforts that the entire industry is putting behind, you will see significant amount of depth getting built in market making as well. And that is what will enthuse more investors also to come in. The fact is that, underperformance of active funds has acted as a tailwind. Once size gets built up, liquidity definitely happens over time. And one should not be overly worried about that liquidity aspect now.
Okay. Now, in the year...
On the liquidity, it's also a for the creation of a market, you need different people with different horizons, just to take Abhishek's point. So there need to be a diversity of investor base, trader base that will need to come in. Unfortunately, again, right now, again, taking the cue from Abhishek, the reality is there are very similar use cases that people are using passive for. We have some institutional investors who are largely on the same side of the trade at the same time. We have some retail investors who are typically using it more as a buy and hold, not as a trading product. So there is a lack of a market in that sense. A market maker is, at the end of the day, is a facilitator, but inherent liquidity will only come when there is actually use cases getting created, and therefore, and it's getting done. So you're getting more use cases getting built. People are creating fund of funds. People are creating trading strategies backed by. And even in the US, I think taking that example, a lot of the active users of ETFs are hedge funds and other investors who are using them for their own strategies. And that's how they are progressing. So yeah, that's a part of the evolution of the market.
In fact, if I were just to add to that, India, the overall ETF liquidity as a percentage of overall passive AUM or ETF AUM is 6 basis points, 0.06%. US, the ratio of liquidity to AUM is 3%. Right? So we need to maybe improve 50 times in terms of liquidity for us to be on par with the developed market. Now, the inherent problem with liquidity is that liquidity pulls liquidity. So, I'm investing in the most liquid ETF. That's why that most liquid ETF is liquid, right? And it is most liquid because I'm investing into it. So it's a circle, right? And broad basing of liquidity, that's why it becomes deferred. And that's why, market making, incentivization of intermediaries become all the more important for broad basing of liquidity. So I need liquidity in each index strategy, so that if I were to execute actively my transactions, my strategies, I can do that easily.
Yeah. Okay. Now I'll move to something very different. The last couple of years, we saw a lot of excitement in the debt space in passives, which was largely target maturity funds. Now, with the benefit, the tax benefits being taken away somewhat from that category, how do you see the future of target maturity funds?
Sure. Yeah, so last year, one of the reasons for this stupendous growth which we had seen in passive was on the back of, as you rightly mentioned, target maturity funds. But we also have to understand a couple of things. With the new, or rather with the changes in the taxation which are set in, it comes at par with similar other traditional products which are deposit, term deposit, or even bank deposit. point to be noted is that it is not worse off than that. So what it has brought in is a parity. So that's point number one. The other points are, there are other core benefits of a target maturity fund, which are like you can have a superior quality, liquidity, which we were all discussing, is very easy over there. You have a predictability of return and so on and so forth. Which are the other key reasons for an investor considering a target maturity fund? All of that remains intact. So we feel that as we kind of come out of the initial, I would say, impact of the change in taxation, and we start looking at and living with it, we would realize that the opportunity of a target maturity fund still exists under the sun, and that opportunity is much widespread and much more rich than the mere benefit of taxation. What we have observed, which we would take it as a knee-jerk reaction, is that in the month of April, the flows have kind of dried because people are reconsidering and evaluating other options. But when we look at, as I mentioned, the features and the benefits which target maturity offers, they really stand tall, irrespective of the tax benefit. And I think investors and partners would gradually realize that, and it would slowly and gradually find prominence again.
So, will you see a deluge of TMFs continue will the deluge continue in the markets? And TMFs, target maturity funds.
Yeah, so we are also exploring, and as we see interest coming in, we would be considering to augment our portfolio as well. Currently, as I say, in the month of April, the flows have been fairly thin in that, but we remain constructive on the opportunity of target maturity as a category.
Okay, the audience here today consists mostly of distributors. And distributors remain not so convinced about the power of passives. So what is it that you want to tell, each one of you wants to tell the audience here?
See, in fact, one of the points which we were discussing throughout is, there are so many passive, it's complicated and so on and so forth. Actually, for any financial investment, and that actually brings into, again, prominence the role of advisors, right? Be it active, be it passive, the investor would need an hand-holding to understand and appreciate their risk appetite, and then look for a product which fits that requirement. And it's the advisors and partners, the investment advisors, the MFDs, and the RIAs who understand that and can help them to help an investor to achieve their goals. So therefore, the requirement and the benefit of the advisors, in fact, actually grows manifold, because the investor has now so many options that it tends to be a little confusing at times. So therefore, I would say the role of an advisor is now actually got increased or enhanced with this multiple aspects of active, passive, and I think there are hybrids within that also coming in. So therefore, we don't see that there is any kind of a less requirement of an advisor. On the contrary, we feel that's an opportunity for advisors over there. And since this whole market is also, moving up significantly, the AUM and the growth, which we all understand and envisage to happen, in the future as well, will give everybody a, greater and bigger opportunity for growth professionally, both the, advisors to be richer with their wealth, and manufacturers also will be able to provide value to all.
No, that's fine. The manufacturers will get their AUM and the investor will be happy. But what about the distributors? Unki jeb mein kya aayega?
So I think ultimately, as advisors, it is the target or the objective is to be relevant to the investor's entire wallet. So what you should do, and I think the mistake we make is to focus too much on product level margins or transaction level margins, because that regime is over. I think we have to look at wallet level margins. There is no other way. So how can we stay relevant to the investor? How can we make a difference to the entire wallet? And if we are making the difference to the entire wallet, we will make our margin at the wallet level. And that's the only way to work. And in that wallet, there will be products that will be more remunerative. There will be other products that will be less remunerative. And that's the way to work. So the minute you let the margin of a product distort your thinking, that is the sure shot way of the investors, because they do read it, right? And they understand that there are certain things that you're not sharing. Now, there is a massive noise, right? And I mean, just as a aside, and don't just maybe slightly flippant, but maybe the average age in this room would be what, 40, rough and ready. Certainly 35 to 40, let's say. And what is the average age of this country? It's 22, 23, maybe something like that, right? So the emerging trends is that the investor will be out there on social media reading about this. They will be looking at what is happening in the US. There is no choice, right? As advisors, it is our job to give them the complete picture and stay relevant. So that's the way to look at it.
No, just to complete the point, in fact, the key is how much of the wallet we are able to address. And there are like products, and we had a discussion on the target maturity. So if you look at that part of the money was actually going into the traditional investments. Through products, albeit passives, that part of the wallet is becoming addressable. I'm just giving this as an example, and there are so many other aspects as well. So the point is, instead of a specific category of product margin, which we all at time get kind of focused on, the increase in wallet share, both at the current point in time, which is the book wallet share, by getting into the investments which were not coming to us, and then the overall growth of the wallet, both put together is the opportunity of volume which is there. And even with book margin being lower than specific product margin, in aggregate or in absolute terms, the revenue opportunity remains probably large and quite remunerative for all of us.
I could just... So I think the point that I want to make ties in some of the points we discussed is with the growth of passives, the role of the distributor is actually front and center, right? Because you have so many options. You just mentioned, even if you consider all the Nifty funds to be just one, you still have so many sector funds. You still have so many other different categories of funds. Now, how does the decluttering happen? It's the advisor's role to do that. And the advisor is now empowered to do it, because let's say an advisor had a view that financial services is going to do well. Earlier, when there was no financial services ETF or index fund, they had to go to a manager who was actively managing financial services, and if the return was not commensurate, that was probably because the manager was not able to, deliver on the promise. Here, if you have a view on financial services, it's very easy for you as a distributor just allocate to a financial services fund. Now, that makes the job of the distributor important, but at the same time also empower the distributor to do things which they perhaps were not able to do as effectively earlier. So from that perspective, I think it's very critical.
Yeah, Sharwan.
So just to address larger question here, that mutual funds are the most tax efficient and transparent investment solutions in the country, because expense ratio, the portfolio, everything is disclosed on timely manner. So you are getting into an industry which is most transparent, at the same time most tax efficient. So, and at the same time, the penetration of equities in India is pretty low as compared to global markets. So we should look at and address larger goal of investors by bringing investors into equities as an asset class, because the penetration of equity as an asset class is pretty low, and mutual funds are offering, both active and passive funds are offering transparent products. And then depending upon investors' objective and risk appetite, probably you can construct a portfolio which could do justice to the investor. And one should not consider active vis-a-vis passive, because both are complementary to each other. If active fund is able to solve the investment objective of the portfolio, you can have some portion in active funds and as a core part of the portfolio, because if you are buying broad market cap based indices, you are getting share of all the listed companies in India. So which means that just by investing in 1 or 2 index funds, you are getting exposure to almost 2/3 of all the companies listed in India. So one should consider these simple to understand market cap based index and allocate large part of the investor's portfolio in these plain vanilla market cap based oriented funds. And then depending upon investors' objective and risk appetite, you can have some bit on some thematic sector funds or some portion in smart beta strategies if that fits in that particular investor's portfolio. I believe apart from these broad market cap based indices, smart beta funds have come in a big way in India as well as globally also. And because these smart beta funds are trying to exploit certain performance factors, and basis that it is constructing portfolio of stocks. So for example, typically in mid-cap companies are much more volatile, and at the same time financial risk is also high in mid-cap companies. So one can have a style index, say quality oriented mid-cap stocks, which are actually less volatile. At the same time, in the longer run, they have outperformed the broad market cap based indices as well. So depending upon the use case of the investor, one can have multiple passive funds, and one should not get disturbed by so many choices, because you need not have all passive funds or all active funds. You should have broadly market cap based indices and then select few thematic sector or smart beta funds depending upon the investor's risk appetite and the investor's objective. Second, on liquidity part, so SEBI and market regulators taking 2-3 big steps. First, they have put in 25 crore threshold, so which means that all the investment below 25 crore needs to be routed through secondary market. So which will go a long way in creating secondary market liquidity in India, and which is in line with the global markets, because globally, apart from market makers, no other investor is allowed to invest directly through AMCs. And second, net settlement process is also going to be implemented very soon, which will reduce the capital intensive nature of ETFs. So which will improve the liquidity of ETF. At the same time, it will bring in a lot more market makers, large banks and large brokers who are currently avoiding ETFs mainly because of capital intensive nature of the business. So I believe because of these regulatory changes, the secondary market liquidity of ETFs will improve drastically going forward.
Okay, great. That's good to hear. Now, in the morning, Anubhav had made a presentation, and he made out a case for passives to be a part of the bulk of the core portfolio and to use active funds as a part of the satellite portfolio. Now, I want each one of you to tell us, you agree with this view? And if you do, why? And if you don't, why not?
Sure. Before I come to the point, I just want to add to the previous point of, we all know that passive is good for investors. I think the real question that the distributors have is, "Main kyun bechu?" Right? Because the margins are, I think that's the real question. On a lighter note, when you go to a Kirana store, the lowest margin product typically is bread and anda, right? And it's an essential commodity, right? Does that mean that over a period of time, the Kirana store stops selling bread and anda? Not really. It's essential for the consumer, and that's how it has to be kept, because that makes a wholesome basket for the consumer. Likewise, if what is good for the investor has to be part of the overall portfolio, if it is delivered through the distributor in a wholesome manner by having a combination. I'll maybe combine this to your point of what's an ideal portfolio, right? A typical ideal portfolio is, again, a cliche core satellite approach of the core, which could be 70 to 80% of your portfolio being low cost, plain vanilla, market cap based beta product, which is, for example, Nifty 50. So when you invest in Nifty 50 based products, it at a cost which on a weighted average basis is 9 basis. So India's weighted average cost for ETF is 9 basis points. Globally, it is 18 basis points. So we are one of the cheapest when it comes to providing passive exposure to capital market. So an ideal portfolio from a layman point of view could be, the core part of 60, 70, 80% lying in low cost Nifty 50 or market cap based products. Now, if that helps, maybe we can stop there. However, if you were to experiment with, certain alpha generating strategies, then that's where the satellite kicks in, because we are a nation of trying to outperform the market and tracking it actively and all. That's inherent, right? So it will take some time for us to be really, really, core passive, right? And that's why this need for having, active strategies, alpha generating around the core, which is the satellite approach. And there, it's more of alignment. So that alignment could be with the risk appetite of the investors and the goals that the investor is trying to achieve. And what you tie up with that is a product, which could be maybe a momentum strategy, if that works. Someone believes in value strategy. Someone says that I believe in buying value stocks, which are typically low price to earning, low price to book, low price to sales, high dividend yield. And that's why I would maybe pick up a value strategy. Someone believes that, okay, Nifty 50 is good, but banking is something that I really like. India is a growing economy. Financial services ke bina kuch hone wala nahi hai. So that's why I want to invest in bank. So incrementally, that satellite approach is, banking. So there's no single answer to this question in terms of what a perfect ideal portfolio should be. The core definitely has to be low cost, passive exposure to capital market, and the satellite is more where the distributor and the advisor kicks in, where he or she aligns the need of the investor with the massive list of ETFs available.
Abhishek.
2017, when recategorization happened, both distributors, the regulator, investors were dealing with an issue of too many schemes, similar sounding or weird sounding names. And then we went in for a massive DNA change of the industry, trying to create an ideal portfolio for larger investor populace as such and the distributors. And what happens in the next 2 years is that because there is a templatization, active alpha is starting to come down, giving rise to passives essentially. What is happening today? Almost every fund house has an NFO of a passive scheme going on at any point in time. In the next 1 year, you will have probably more or equal number of passive schemes as active schemes. This problem of active versus passive will never end, to be honest. And it's not really a problem, it's a perspective. If you ask me personally, given my personality, investment personality, I don't need an active scheme. My 100% portfolio is passive today. And I'm very happy with it. But I also know of very happy investors who are 100% in active schemes. So there is no one answer to it. I think the question is, and especially from the perspective of distributors here, and I would probably allude to your earlier question, distributors are not convinced. I completely disagree with that, by the way. The fact that you have a larger population of distributors here today compared to the last year's conference, the fact is that they are more convinced and they are more interested. You look at the breakdown of target maturity funds. You have a large retail population that has come in. Why have distributors sold corporate bond funds after having sold, let's say, credit funds? Because they believe what is right for the investor is right for them also. So coming back to this question, a core satellite portfolio of passive plus active, to each one his own. You have to look at who the investor is, what their investment personality is, risk appetite is, and accordingly fill it up. As Aman put it, I think a larger part of your problem can be resolved with the right solution. What you really need to look at today is persistency of portfolios, not churn of portfolios. Those times are gone. I think as Ashwin had mentioned earlier, that product-based margin pricing has to give way to size, scale. We are looking at 40 lakh crore going to 100 lakh crore. 16.5% of AUM to GDP ratio going to 75% AUM to GDP. Take your choice. What is right?
So we had Aman favoring core in passives and active more or less in satellite. Abhishek says to each one his own, decide based on the client. What is your view? Yeah, you can say Yeah, you can even do 100%. But as a matter of philosophy, what would you advise someone who's in the distribution business?
I would say, I think the short answer is to each his own, because there is, as we have found out in this, it is a very something that has to work with your values, with your risk appetite, with your horizon, what you're trying to do. Having said that, I also want to say that the objective has to be right. If we are adding more passives, let us be clear, what is it that we are adding? What is it doing for the portfolio? What is it that that index has at the back end, which it will give us? What is it that our existing active portfolios provide us, which is different from this product? So it sounds like a lot of work, and that's why I want to repeat my earlier point that there is no shortcut here. It just passive does not give you the license to say that I don't have the time to spend on this portfolio. Ek kaam karte hain, let's just put 50% into passives and we'll worry about it later. No, because at the end of the day, it is the same risk, right? In India, if you look at active funds, if you look at the betas, you can look at the risks. At the end of the day, what does the investor want? Nobody cares about alpha, right? They all want what is it that I'm going to make in my portfolio as an actual return, and what is it that is the actual risk in my portfolio. And we spend too much time on saying that this was the outperformance, underperformance, or relative to a certain index what has happened. When what we really need to worry about is the actual return of the portfolio. So there has to be a rationale for why we have chosen a certain mix, and there is no right answer, unfortunately, on this.
Okay.
Quickly, can I go? So I'd like to answer this question a bit differently. I'd like to say what I would do in my portfolio. I believe no matter what equity investment you make, I'm currently only talking about equities, we can extend it. But in equities, if you believe capital asset pricing model or any such model, around 60 to 70% of your risk exposure comes from being exposed to the market, right? So I would want to construct my portfolio where 60 to 70% of my portfolio gives me that market exposure at the cheapest possible price, which essentially means it has to be passive. And for the balance, I essentially want to place my bets on those strategies which have the highest divergence, maximum correlation benefit, put it another way, the least overlap with this core portfolio that I have. For example, I would want to look at the active share of a particular fund. If that active share is somewhere around 85%, meaning 85% of the portfolio is different from the market portfolio, that gives me the highest odds, not of outperformance, but of different performance from my core portfolio. And I would want to select something like that in the balance 30%. So that's why I would structure my portfolio.
Okay, very interesting. That was a very interesting perspective. Sharwan, what do you say?
See, if you look at the portfolios of various investors, we will find that they will have all mix of funds, in the sense, if they are having about 10 odd funds, 10 odd equity funds, and then if you just combine the portfolio, 10 odd portfolios, and then check the correlation of that particular portfolio vis-a-vis any index, you will find that there is very high correlation of combined portfolio, because at aggregate level, markets will, all the mutual funds, especially active funds, will generate returns which are closer to the portfolio. If only mutual funds are allowed to invest in equities, in that case, aggregate returns would be close to the market returns. But you have to pay the fee for that particular portfolio. So which means that having wide variety of active funds which are having on aggregate basis very high correlation, then actually it is not making sense. So ideally one should have core part of portfolio to be in large cap companies, and generally we have seen that alpha generation abilities, especially in large cap space, has started diminishing, not only in India but globally as well. And as per SPIVA report, which publishes performance of active funds vis-a-vis the relevant benchmark, about 70 to 80% of the active funds, especially large cap funds, are unable to beat the benchmark on consistent basis. So which means odds are against you. So then why not go for passive funds which will generate returns which is equal to market returns. And then depending upon your view on the market, you can have certain thematic funds, certain sector funds, or smart beta funds, either on active side or passive side, depending upon your conviction on the fund manager or that particular style.
Okay, interesting. So we have both the participants on my left advocating a very passive-heavy approach.
See, the way I would like to approach this is, if the allocation is to be made across various categories, for an investor, in that category, which is the best option is what which need to be provided. And it is not that, it's a passive. If the active offers value, that needs to be, recommended. And I'll give an example. Let's say large cap, right? The view is that for large cap, maybe passives offer better return. And for one, we have to understand one of the major reason why a large cap index tend to outperform a large cap active fund is nothing to do with the fund manager's ability or opportunity to outperform. It is because of the construct. We all know large cap is defined by the top 100 stocks, right? So therefore, the possibility of active share, right, having opportunity to, invest actively is less. And also there is a risk management which a fund manager may want to put in. And again, give an example. If a particular corporate house, a manager is not comfortable with, they'll not invest in that. But the index has that. And if that particular group outperforms, there is a underperformance in the active fund. Second, a particular sector has over 45% weightage in the index. A fund manager, as part of the risk management, may not want to take that skewed a call. And that part outperforms, and therefore there would be a gap between active and passive. So in cases where the active share opportunity is less, the passive may outperform, and the glaring example which we all keep talking about is large cap. So if I have to allocate large cap, I may choose a passive out there. Let's not forget the fact that India remains an, in the active management and outperforming market. Active, in most of the category, active management of funds still outperform a passive management. So in categories, if an allocation is to be made, say mid and small cap, there are opportunities in the active space, funds which are there which outperform passive. So if I may have to choose, I may choose an active fund within that bucket, and so on and so forth. For example, if I have to take a thematic fund or a sectoral fund, actually the choice should be that, okay, these are the 20 active funds, these are the 20 passive funds. Now between these 40, which one fits the bill aptly? The one which fits the bill is the one that needs to be chosen. There should not ideally be a distinction made that, okay, this is a passive in color, this is an active in color. So therefore that we feel is an opportunity, and the solace we derive is in India still, in most of the categories, as I mentioned, active does outperform, and therefore the opportunity for active funds are still there, glaringly, and therefore from an allocation standpoint or opportunity standpoint, the opportunity of active alongside passive remains pretty big and large.
Okay, with that, we've run out of time now. So thank you, my co-panelists, for making this an interesting discussion. Just to summarize what the entire panel has been discussing. Oh, Ash, you have a question? Sure. Please.
This debate is about what should distributors do in this scenario. I have a simple suggestion. If you have expertise to pick sectors, and think about it seriously, passive is not about just putting your mind aside and saying, the first presentation that was made that point. You are going to pick sectors on behalf of your clients. Have you the expertise to do that? And only if you do that, then get into passives. Because your client is going to depend on your choice of which passive to go for, right? Do you have expertise to say that this particular passive has got maybe, large cap banks is good? Have you the capacity to analyze all that? Because that's what the active manager is doing, right? Now you're taking him out of the equation, you have to do that. That is the first and foremost answer to find for yourself, and then decide, are you going to go there? When it comes to remuneration, that's a very simple progression. Today, it's obvious for you that as distributors, index funds is going to be more remunerative than ETFs. ETFs may not earn you anything. But if I was in your place, I would get myself a work towards getting a brokerage license or a sub-brokerage license so that I can give my client whichever mix is the most relevant, provided I have expertise to know which passive part of the market I should take my client today. So this is my 2 bits of contribution.
Okay, thank you, Ash. You bring in an interesting perspective. Thank you so much. With that, we've come to the end of this session. Just summarizing the key points here is that, yes, there is a need for distributors to actively look at passive funds. There is money to be made. There is an opportunity. There's greater client retention. As far as having passives as a core component of your portfolio or as a satellite component, the view was different, but at least 3 people I can count on who said that passives should form the core of your portfolio, and the others said that let the client's risk profile dictate that. With that, I come to the end of this discussion. Thank you so much, Aman. Thank you, Abhishek. Thank you, Ashwin. Thank you, Sirshendu. Thank you, Sharwan. And thank you, Shankar. Okay.